Supply and demand. By mastering this concept, you're going to catch big risk to reward trades and become a profitable trader. In this video, I'm going to attempt to simplify this concept so that you can understand it easily and apply it to your trading. Everyone's heard that markets are supply and demand, but on a chart, this looks different than you might expect. Areas of supply and demand develop on a chart as large institutions look to enter and exit the market, creating major price moves. The next time you're seeing a market trend up, try this. Wait for a retracement back to a demand zone. This is going to give you a more favorable risk to reward, as we're going to use this concept to buy at the area where institutions are looking to enter the market. In the moment, it always feels like rallies will never end. So why should the market return to this zone instead of just continuing straight up like it feels? Well, very often there won't be enough demand or buying interest to keep pushing prices higher, because big players need big liquidity to get in. So they're gonna need to see price revisit a few times to fully enter their position. It's the same thing with supply zones. There won't be enough people interested in selling, so the market is more likely to go back up to a supply zone before reversing. This is when prices are more expensive, so traders are more likely to enter sell positions. But Tom, where do we find these supply and demand zones? There's actually a few ways to draw them, but I think the best way is the pivot zone. Typically, this will look like a pivot in price. You can sometimes take this from a single candle, but depending on how refined you want to be, you may want to find a 3 or more candle setup. When identifying supply zones, we'll usually mark out the bullish candle right before the move down. And with demand zones, we'll usually mark out that bearish candle right before the move up. Here's a few rules to approaching this. Not every zone is going to work, so your goal is to find the high probability supply and demand zones to take positions from. You're going to be looking for zones that have already had their liquidity swept, because remember, institutions need those trades on the opposite side. They need you to sell into their buys, and they need you to buy into their sells. This will allow them to enter positions with minimal slippage when they enter or exit the market. Another rule is that I typically look for an imbalance to be created. This is usually when institutions are entering the market, causing rapid expansion towards one side or the other. And the last one is that these zones require a break of market structure. Remember, it takes a ton of money to move price, and even more to break structure on a liquid instrument. So with these 3 rules, we can identify the footprint of where institutions are looking or have entered the market. And with that, we can bank consistent profits. So let's show you what this looks like in real time, so you can spot these trading opportunities. Right off the bat here, we can spot equal highs. This is an area that we can identify of liquidity. The market will be very attracted to this, and it's very likely that it will look to take them out. And right here, the price does just that, creating 3 bullish candlesticks that are going to act as supply later on. As the market developed, it broke the swing low with a large bearish candlestick. Now, all the rules that we've laid out have been met for a high probability supply zone. You know what to do now. Look to enter that short, set your stop loss above, and adjust to whatever risk to reward you want. On the flip side, here we can see the market has been downtrending. At one point, it reversed and began to start moving up cautiously. This created our first change of character. We can also see this demand zone meets all of our rules, so it's going to give us a high probability trade setup. Liquidity has been swept and it's proceeded to break structure with a rapid energetic move to the upside, leaving behind a fair value gap. Traders could look to enter long here. However, this is a more aggressive entry because this could still be a liquidity grab before price moves lower. So we want to wait and see if the market respects that demand zone. This will be confirmed on a higher high. Okay, so it did respect it, and it's starting to make a series of higher highs and trend up. For a high probability long, we can wait for a retracement and then look to enter. While supply and demand zones are relatively easy to understand, they're actually really powerful when mastered. So if you found some value in this video, I ask that you just share it with a trader that might get value too. Leave a like, subscribe to the channel for more of this content, and leave a comment in the video description below and let us know what topics you'd like to see covered next.